Everyone thinks Russia collapsed in 1998 because oil prices fell, because the government mismanaged its economy, because the young post-Soviet state simply wasn't ready for capitalism. But that's only the surface, a convenient story to explain a catastrophe that was mathematical long before it was political. The truth is stranger. Russia didn't go bankrupt because it was poor. It defaulted because it was rich in promises. Promises to creditors, promises to oligarchs, promises printed on paper called GKOs, short-term government bonds that multiplied faster than the rubles or the oil that were supposed to back them. Every empire in financial history has done the same trick. France did it in 1789 with paper assignats, America in 1929 with margin debt, the British with their colonial bills, the USSR with central planning. Each thought they'd found a shortcut between time and money, and each paid for it the same way: collapse. Now imagine Moscow, August 1998, a city of glass towers rising beside kiosks selling cigarettes in dollars. Western consultants walking through ministries that still smelled of Soviet dust. The ruble traded like a fragile souvenir, defended by foreign loans. At the heart of it all sat a machine, the Ministry of Finance's bond program, designed not to create value, but to buy time. Time for reform, time for politics, time for illusion. And as long as the West kept lending and the printing presses of debt kept running, the illusion held. Until one morning, August 17, 1998, arithmetic spoke louder than ideology. The Russian government announced it could no longer pay its debts. The ruble was devalued. Banks froze accounts. Middle-class savings vanished overnight. It was the biggest sovereign default since World War II. But if you look deeper, you see it wasn't just Russia that defaulted. It was an entire idea. The dream that you could build a capitalist system on borrowed confidence. That you could create a market economy before creating trust. That debt could replace production and foreign loans could replace national savings. The paradox is brutal. Russia didn't default on its money. It defaulted on belief. And here's the twist. Every generation repeats the same formula under new names. In 1998, it was GKO bonds. Today, it's derivatives, treasury swaps, and algorithmic leverage. The labels change, but the principle is identical. When the numbers outrun the real world, something snaps, because arithmetic never negotiates. If this opened another side of history for you, comment where you're watching from. To understand why Russia fell in 1998, you have to see the machine they built, not the headlines about reforms and shock therapy, but the actual mechanism of money that operated behind them. It didn't begin with the crisis. It began the moment the Soviet Union stopped believing in its own ruble. It was 1991. The red flag came down over the Kremlin, and with it fell the last planned economy of the 20th century. The state factory stood silent. Workers waited for salaries that no longer existed. And the new government faced a question no empire had ever answered successfully. How do you privatize an entire civilization overnight? Western advisors from Harvard, from the IMF, from the World Bank had an answer. They called it transition economics. It sounded scientific. In reality, it was alchemy. Turn debt into ownership. Turn paper into power. Their logic was simple. If you can't produce enough, borrow enough. Borrow to pay pensions, borrow to buy time, borrow to convince investors that the system works. And so in 1993-94, under Finance Minister Boris Fyodorov and later Anatoly Chubais, Russia launched its bond program, the GKO, the State Short-Term Obligation. It was supposed to be a harmless instrument, a way to borrow for a few months and then roll it over. In practice, it was a time bomb disguised as modern finance. The Ministry of Finance printed GKOs like tickets to a future that didn't exist yet. Each one promised high returns, sometimes 80, even 100% per year, because no one trusted the state enough to lend for less. But to pay old investors, new investors had to be found. That is not investment. That is a Ponzi scheme, written in bureaucratic ink. The central bank defended this pyramid with foreign reserves borrowed from the International Monetary Fund and the World Bank. The IMF, in turn, called it stabilization. They said Russia was being taught to live in a free market. But in truth, it was being taught dependency, a system where sovereignty was mortgaged for liquidity. Think of it like this. The Soviet Union ran on ideology. Post-Soviet Russia ran on interest rates. Before, loyalty was the currency. Now it was yield. And every oligarch, every Western fund, every government official played the same game. Take short-term profit, leave long-term risk to the state. Between 1995 and 1998, the numbers exploded. The total GKO market reached almost $60 billion, half of the country's GDP. Oil prices collapsed to under $12 per barrel. Tax collection barely worked, and yet the illusion of stability continued, because the money coming in wasn't earned, it was borrowed. You could feel it in the air of Moscow. Imported suits, foreign cars, champagne at privatization parties. A whole generation believed it had entered the global economy. But the global economy they entered was not a marketplace, it was a casino, and Russia was the collateral. Look at the pattern. Every empire builds a mechanism to hide its weakness behind credit. Britain did it with colonial bonds, America with subprime mortgages, France with paper assignats, Russia did it with GKOs. Each one at first is called innovation. Each one later becomes crisis. By 1998, the math was merciless. Every day, the government needed billions just to refinance yesterday's promises. The interest rate spiral outpaced real growth. The numbers grew, but trust, the real foundation of money, did not. That's how the machine was built, out of fear, foreign advice, and domestic illusion. A house of debt standing on a foundation of hope. Because systems don't collapse when people are evil. They collapse when numbers outgrow the real world. If you're still with me, if this made the logic behind 1998 a little clearer, write in the comments, Arithmetic remembers. There's always a moment before collapse when everything looks perfect. The champagne flows, the graphs point upward, and every minister swears the reforms are working. For Russia, that moment came between 1996 and 1998. 2 brief years when the whole world believed the impossible. That a country destroyed by hyperinflation, mafia capitalism, and unpaid wages had suddenly become an emerging market success. But look closer. What seemed like growth was leverage. What looked like recovery was borrowed time. The illusion began with a political miracle. In 1996, Boris Yeltsin, deeply unpopular, with single-digit approval, somehow won re-election. Western media called it a triumph of democracy. What they didn't say was that it was financed by the same banks that were buying government bonds. Oligarchs poured millions into Yeltsin's campaign not out of loyalty, but protection. They knew a communist comeback would end privatization, and with it their fortunes. So the printing of promises accelerated. After the election, Russia seemed reborn. The ruble was stabilized. Inflation, which had once eaten people's savings overnight, slowed to single digits. Western funds arrived. Moody's and Standard & Poor's began rating Russian debt. Goldman Sachs issued research notes calling Moscow the next Wall Street frontier. The IMF kept lending, another $22.6 billion package in 1998 alone. For a while it worked. Moscow's skyline started to glitter. Rubles could be exchanged for dollars without black markets. Restaurants accepted credit cards. To the outside observer, it looked like Russia had joined the civilized world of finance. But inside the machine, the math was already turning against it. The government had to pay 40% annual interest just to keep investors buying GKOs. Half the national budget went to servicing debt. It was like paying rent with another loan every month, sustainable only as long as someone keeps lending. Still, the illusion had its music. Television talked of new capitalism. Newspapers ran stories about stockbrokers, not miners. Banks opened branches with marble floors while factories in the provinces stood cold and silent. The nation had split into 2 realities, one denominated in dollars, another in despair. And like all illusions, it depended on confidence. Investors believed Russia was too big to fail. The West believed the IMF would never let a nuclear power default. Russians believed that after years of chaos, at last things were normal. But normality is the most dangerous drug. When everyone stops questioning how the money circulates, the countdown begins. There was a kind of optimism that only appears in artificial prosperity, the same kind Argentina had before its 2001 default, or America before 1929. People confuse liquidity with wealth. They see the flow of money and mistake it for creation. But circulation without production is not growth. It's heat without fire. By early 1998, the illusion was running at full brightness. The Moscow stock index had risen sixfold in just 2 years. Journalists called it the Russian miracle. And maybe, for a brief moment, it felt like one. But every miracle is just physics we don't yet see. And behind those bright charts was a simple equation. More debt than income, more hope than trust. That's the law of every speculative age, from John Law's France to the dot-com bubble. When everyone is making money, no one asks where it comes from. In 1998, Russia didn't lack intelligence or ambition. It lacked patience, the one currency that never inflates. The GKO market wasn't evil. It was a mirror, reflecting exactly what the world wanted to believe, that capitalism could be imported like Coca-Cola, that democracy could be leased, that debt could stand in for dignity. And as long as the mirror didn't crack, everyone smiled. But behind the glass, pressure was building. Because illusions don't die, they burst. It happened quietly, as all financial implosions do. No explosions, no tanks, no revolutions. Just numbers on screens that suddenly stopped making sense. The date was August 17, 1998. The Kremlin issued a short statement. Russia would restructure its debt, devalue the ruble, and impose a moratorium on payments to foreign creditors. 3 sentences that erased half a nation's wealth. People woke up to find their savings frozen. Banks locked their doors. The ruble, which had been traded at 6 to the dollar, collapsed to 20, then 30. In a single week, purchasing power fell by 2/3. Moscow ATMs ran out of cash. Supermarkets switched to dollar pricing overnight. The television anchors tried to sound calm. Temporary measures. Technical default. But the truth was obvious. The pyramid had fallen. The GKO machine had reached the point of mathematical exhaustion. The state owed more in short-term bonds than it could possibly refinance. Even with IMF loans, there wasn't enough money to cover interest payments. Oil prices at $11 per barrel provided almost no revenue. Tax collection had collapsed. Each new bond issued simply delayed the inevitable. The trigger came from abroad. When LTCM, the American hedge fund, began dumping emerging market assets that summer, investors fled from Moscow like a stampede. Foreign funds sold GKOs, converting rubles to dollars, draining the central bank's reserves. In just weeks, more than $4 billion in reserves evaporated. The Bank of Russia raised interest rates to 150% to defend the currency, a move that only killed the few industries still alive. Arithmetic doesn't care about ideology. You can negotiate politics, you can spin the media, but you cannot argue with compounding interest. The shockwaves were immediate. The mighty banks of the new Russia, Incombank, SBS Agro, Menatep, collapsed one after another. Credit lines vanished. Wages went unpaid. The new middle class, proud of its dollar accounts and imported televisions, suddenly found itself bartering for groceries again. In provincial cities, factory workers returned to receiving payment in soap, vodka, or canned meat. It wasn't just an economic collapse. It was a psychological one. The idea that Russia could become a normal capitalist country, gone in a week. Western investors called it betrayal. Russians called it humiliation. But in truth, it was exposure. The moment the mask fell off and the machinery underneath was revealed. Because a pyramid is stable only as long as the base keeps expanding. When confidence stops growing, the structure inverts and gravity takes over. The default of 1998 was not a failure of reform. It was the mathematical end of illusion. And yet, paradoxically, it was also the beginning of something else. When the debt cleared and the ruble hit bottom, a new cycle began. one built not on IMF loans, but on oil, gas, and state control. The trauma of 1998 taught Moscow a cruel lesson. Dependence on foreign credit is national vulnerability. You can call it collapse, or you can call it rebirth. But every rebirth requires a burial first. From that August day onward, Russia stopped pretending it was a Western apprentice. It began learning a different game, the one where money and power are inseparable, and where the state, not the market, writes the final equation. Because when arithmetic breaks politics, politics rewrites the arithmetic. If this moment of truth made you feel that strange mix of fear and recognition, write in the comments, the mirror shattered. You might think the 1998 default was buried in history, that Russia learned its lesson, rebuilt its finances, and moved on. But money has memory. Every system carries the DNA of its last collapse. What happened after 1998 wasn't a clean recovery. It was a mutation. When the ruble fell and the old banks died, the people who rose from the ruins weren't economists. They were power brokers. The state re-entered the economy not as a referee, but as a player. The IMF was thanked, then quietly shown the door. The message was clear. Never again would Moscow depend on Western credit to survive. By the early 2000s, oil prices began to rise, $20, $30, $50 per barrel. Suddenly, the same system that had collapsed from lack of liquidity was drowning in petrodollars. The Kremlin paid off IMF debts ahead of schedule, built up foreign reserves, and launched the National Wealth Fund. On paper, the cycle was broken. Russia had gone from debtor to creditor. But the structure, the invisible architecture, remained the same. The state still ruled through control of money flows, not production. In the 1990s, it had been GKOs. In the 2000s, it became energy rents. Instead of borrowing from banks, the state borrowed from the future, selling gas and oil as if the world would always need them. Instead of investors demanding yield, it was citizens demanding stability. Both were promises. Both required faith. And faith, like any currency, inflates. In the 2010s, Russia's economy began to feel a familiar tightness. Oil prices fell again, sanctions arrived, and reserves became the new GKOs. The buffer everyone trusted but few understood. The central bank defended the ruble just as it had in 1998, only this time with digital instruments, not paper bonds. The mechanism evolved, but the principle remained. Borrow confidence, spend it, defend it, lose it. Look at the world today. The pattern is global. America prints trillions in stimulus. Europe issues endless sovereign debt. Japan's central bank owns half the stock market. Everyone is running the same algorithm Russia tested in the 90s. Replace real productivity with financial engineering and hope the math never catches up. But math always catches up. It might not wear the same uniform, but it obeys the same law. In 1998, it was ruble bonds. In 2008, mortgage securities. In 2020, quantitative easing. Each time, we say it's different, more sophisticated, more managed, more secure. And each time, the gap between numbers and reality widens until belief collapses under its own weight. The Russian default was a warning written in Cyrillic, but addressed to the entire world. You can default not only on money, but on trust. And here's the irony. The default that humiliated Russia also made it immune to later shocks. When the global financial crisis hit in 2008, Moscow simply nationalized banks and moved on. It had already lived through a death of confidence. The West hadn't. That's why Wall Street panicked while Russia watched with cold familiarity. History doesn't repeat. It rhymes in currency. And each verse is about the same addiction: leverage, illusion, and the denial of limits. The day Russia defaulted wasn't a Russian story. It was a rehearsal. If you're hearing this in 2025, remember, the same forces that broke the ruble are now measured in dollars, euros, and data. The stage is bigger, the script is the same. Because the system didn't die, it evolved. and it's still running until arithmetic decides otherwise. If this part made you see the present through the echo of 1998, write in the comments. The cycle never ended. Every empire ends the same way, not with invasion, not with revolution, but with a balance sheet. Numbers are history's quiet assassins. They wait, patiently, beneath ideology, beneath speeches, beneath flags. And when the time comes, they erase illusions faster than any army. Russia in 1998 proved this law. It wasn't an accident of bad leadership or bad luck. It was arithmetic collecting its debt. When a society starts borrowing from tomorrow to pay for yesterday, collapse is only a question of time. The paradox is that everyone believes they'll be smarter than the last generation. The French thought assignats were progress. The Americans thought subprime mortgages were innovation. The Soviets thought planned quotas were rational. The Russians of the 90s thought GKOs were capitalism. And we think central bank digital money is stability. Each time the form changes, the function remains. Faith replaces gold and promises replace work. But faith, once monetized, becomes fragile. When trust becomes a financial instrument, its value starts to fluctuate. That's what money really is, quantified trust. And when that trust is printed faster than it's earned, default becomes destiny. If you look carefully, you'll see the same mechanism still ticking today. The state, any state, cannot create wealth. It can only redistribute belief. Every bond, every guarantee, every stimulus is an IOU written to the future. And the future always sends the bill. That's the lesson of August 1998 and of every economic empire before and after. Systems don't collapse because people are greedy or stupid. They collapse because numbers outgrow the real world, because arithmetic, unlike ideology, doesn't forgive. So if you're listening to this now, 27 years later, understand. What fell that summer wasn't just the ruble. It was the illusion that you can build prosperity on promises. When the numbers stop believing in you, the rest follows.